Everyone talks about listing day gains, but the real work of an IPO happens month before the bell rings. Today, we are breaking down the initial phase of the Indian IPO process, specifically the three hurdles a company must cross to get SEBI's nod. SEBI is the regulator of Indian market. So, step 1, hiring the merchant bankers, also known as book running lead managers. Think of them as the wedding planners for the IPO. These bankers run the show. They conduct due diligence to check if the company is legally and financially sound, and they help decide the company's valuation. Step 2, the heavy lifting, the DRHP. This stands for Draft Red Herring Prospectus. It's the Bible of the IPO. It contains everything: financial history, who the promoters are, and most importantly, the risk factor. It tells investor exactly what could go wrong. So, why is it called red herring? Because the information is incomplete. It does not have the final price or the numbers of shares yet. Step 3 is the regulatory test. The bankers file this document with SEBI, the market regulator. So once filled, it goes public for 21 days so people like you and me can comment. Meanwhile, SEBI reviews it strictly to ensure adequate disclosures. If SEBI is satisfied, they issue an observation letter. This is the green signal. The company now has 12 months to launch their IPO. So once the letter comes in, the race to the stock market truly begins. Wants to know how the price is decided? So let's go for part 2 of the video. So when you buy a shirt, the price is fixed. But when you buy an IPO, the price is actually a discovery. Welcome to part 2. Today we are decoding how an IPO price is decided. In India, we use a method called the book building. It starts with the valuation. The merchant bankers compare the company's profits with similar companies in the stock market to find a fair value. So next is the roadshow. Bankers pitch the IPO to big investors like mutual funds to see how much they are willing to pay. Based on the feedback, they do not pick one price, they pick a range called the price band. The lower end is the floor and the higher is the cap. When the IPO opens, you get to bid. You can offer to pay the floor, the cap, or anything between. The collection of bids is called the book. After 3 days, they check the demand. The price at which they can sell their shares become the cutoff price. So here is the pro tip. In a hot IPO, if you do not bid at the cap price, the highest price, that is the highest price, your application will likely be rejected immediately. So the market actually decides the price, not just the company, but what happens after you bid. So how do they decide who gets the shares? So that is in the part 3. So if you have watched us till here, then do subscribe, and we'll go to the part 3 now. Applied for 5 IPOs and got nothing? You are not unlucky. You are just playing by the wrong rules. So welcome to the part 3. Today we explain how the computer decides who get the shares. For retail investor, that is us, it is a pure lottery. Here is the biggest myth. You think applying for more shares increases your chances? It does not. If an IPO is oversubscribed, the computer treats person A and person B exactly the same. It picks winners randomly to give them just one lot. What if you have more money? You enter the NIA category. SEBI recently changed the rules here too. So for small HNI, that is high net worth individuals investing between 2 to 10 lakhs, it is still a lottery. You do not get an advantage for bidding higher within this bracket. So how do you actually win? So stop bidding for 10 lots in one account. Instead, use the family method. Apply for one lot each in your different accounts, 4 tickers is equal to 4x profitability. Now you know how the price is fixed and how shares are allotted. But what happens on the big day? How do you sell for a profit? So that is the final. So listing day strategy. So let's go to the part 4 of this video. Did you know you can sell your IPO shares before the market actually opens? If you wait until 10 am, you might be too late. So welcome to the IPO finale. Today we master listing day. The magic happens between 9 am and 9:45 am. This is the pre-open session. The exchange collects all orders to decide the listing price. You can place orders here. So if you are here for quick cash, sell in the pre-open. Don't wait for 10 am volatility. Here is the trick. Place a limit sell order. Set the price at the issue price or very low. Don't worry, you won't sell it cheap. The system will automatically sell your shares at the final listing price. That is, if you could take an example like 500, this guarantees you an exit. Investing for the long term, use the capital protection strategy. If the stock doubles, sell 50%. You get your principal back. Use the capital protection strategy. Okay. The remaining shares are now free. You can hold them for 10 years with zero stress. One final warning. Small IPOs often have a 5% lower circuit. If you do not sell early, you might get stuck for days without being able to sell. So that is it. Graduated from the IPO Academy. You know how to apply, analyze and sell. Good luck with your next allotment. Thank you.